Investor Intelligence provides general information only. You should consider seeking independent advice to see how this information relates to your unique circumstances. Please refer to the terms and conditions available at investorintelligence.com.au for more.
Hello and welcome to this week's episode of Investor Intelligence, brought to you by the team at the Property Mentors. It's your weekly podcast for all things investment and hosted by me, Phoebe Sikowski-Wallace. So I, for one, am very excited for today's topic, as we're going to be exploring a topic that is becoming increasingly relevant and increasingly relied on in today's economy, and that is the bank of mum and dad. So joining me to discuss this topic is not one but two guests that our listeners will be very familiar with by now. The first is the lovely Chelsea Burton, which if you haven't heard any of Chelsea's episodes, Chelsea is a senior broker at an independent mortgage broking firm used exclusively by the Property Mentors and who specialises in investment property loans. Chelsea, welcome back.
Thanks for having me.
Anytime. And also joining me is, of course, our CEO of the Property Mentors and our investment expert, Mr. Luke Harris. Welcome back, Luke.
G'day, Phoebe. Hello, Chelsea. How are you?
Very well, thank you. Guys, so for many young people, getting onto the property ladder, whether that's to invest or to buy a place to live, can almost seem like an insurmountable challenge at this point. We've got rising costs, we've got stagnant wages, making it difficult to save up enough money. So for many people, this is where the bank of mum and dad comes in, as parents and other family members step in to provide financial support and help their loved ones achieve their goals, whatever that may be. So today I wanted to talk to you both about this in more depth, because I know both of you will be able to share slightly different angles on this, but I want to talk about, how this arrangement works in practice, what are some of the benefits and drawbacks of both sides, and just some of the realities that relying on family support in today's challenging financial landscape, what that looks like. So Chelsea, I want to start with you. Can you tell me what the bank of mum and dad is, and is it just your parents giving you money, or is there more to it?
So Bank of Mum and Dad is basically, yes, parents helping out with a deposit and costs for a purchase. There's a few different ways that it can be done, and it all depends on the parent's financial situation. They can give you cash. They can do an equity release on their home or investment property and give you that money, or they can put one of their properties as security for your loan so that it brings down your total loan to value ratio and you don't have to put in extra money.
Yeah, okay. So there's a little bit more to it than just giving you cash as a nice offer.
Giving people cash is not always something that people could do.
Yeah, of course, yeah. And Luke, I've not only got you here today as our investment expert, but as also someone who is very open about the fact that when you started out, you were fortunate enough to be able to rely on the bank of mum and dad, correct?
Yeah, I guess prices were a little bit lower back then, but I guess it's all relative compared to what it is now. A 10% deposit now is very different to what it was back then. But I think I borrowed about $15,000 or $20,000 from mum and dad when I first started. I had saved a deposit, but we saw prices moving, and I was very, very convincing to mum and dad when I was a little bit younger, and they wanted to help me get started because they knew that I was obviously very keen to get into the property market, and they knew that property was safe as far as what they'd been through themselves and the growth that they'd seen in their own portfolio and their own property investments. And they lent me some money to get started, and I was very, very keen to pay that back as quickly as possible.
Did you have any apprehension about asking your parents for this assistance at all?
Didn't think twice.
Yeah, okay.
Didn't think twice. For me, it was. Look, I was in a position where I was looking at properties. Mum and dad knew I was very serious about it. The only reason I actually had to ask because I was actually self-employed, so the banks actually just required a larger deposit. And as a 19-year-old going out there to look at property, being self-employed, it was actually quite difficult. Yet one of my staff was an employee of mine. He went and bought his first home as a staff member of mine because he was on a PAYG job. And I think that was at the time where I had these conversations with mum and dad saying, hey, I want to get into the property market. I've got my deposit ready, but it's not enough because I'm self-employed. So it was just that extra little bit of a deposit to help with getting that loan approved.
Yeah, definitely. Yeah, there's obviously going to be so many different reasons as to why people would rely on the bank of mum and dad, apart from it just being very convenient for many. But I'll open this next question to both. What are some of the other benefits and then drawbacks of relying on the bank of mum and dad for financial assistance? I can start with you, Chelsea.
So benefits are that you can avoid mortgage insurance, potentially. Also, potentially, it means that you don't have to have a deposit saved. Mm-hmm. So depending on how much cash or equity they've got, if you can get your loan down to under 80% of the value of the property that you're buying because you're adding equity from them or cash from them, then you don't pay mortgage insurance. Potentially, if they've got enough equity in their property or enough cash, you don't have to come up with a deposit at all.
Okay.
And it just means that you can get into property a lot faster than you probably would if you were trying to save yourself.
And then I guess some of the drawbacks then?
Drawbacks are that you're putting your parents at a little bit of risk, particularly if they're guarantoring. If they're giving you cash, there's not really any drawbacks to that unless they're expecting that money back, and family dinners get a little bit tense because you've been out spending money and they want their money back. But if you are using their property as guarantor, then they're on the hook if you don't pay your mortgage.
Yeah.
Which, depending on their life stage, can have some pretty serious consequences.
And Luke?
Look, I think it can be benefit for a lot of people if there's a good relationship to begin with, and the parents have seen that you have good money habits. I think that's probably the key thing to factor in here. If people getting into the market, and a lot of people don't have good money habits and they're not good at saving and they haven't really put the effort in themselves. But a lot of parents, if they're in a financial position to do that, and it doesn't mean that everybody is, but for those parents that are in a financial position to help their kids out, most parents do want to help their kids at some level. It doesn't mean giving them money, but if there is a way to help them get into the property market without having to wait, then a lot of parents are open to that. It's just a lot of people not really understanding how to help their kids. And I think this is the reason for the podcast today, is just to explain to people what you can do if you want to help your kids, or if you've got parents that might have a bit of equity, how to actually have this conversation with them. So send them a copy of this podcast. But let the podcast do the work for you. But really, I think for a lot of people, it's understanding what's actually involved and what the risk is. So a lot of people think, look, if I want to help my kids out, then I'm going to have to give them money. It doesn't necessarily have to be a gift. It could actually just be a loan. It could be between family members. Obviously, how that's put down on your financials is different for each lender, and that's probably Chelsea's sort of area of expertise to discuss how that's presented to the banks. But from my perspective, mum and dad were looking at me saying, well, he clearly wants to get into the market. He's got some good money habits. He's been saving for a long time. He's got a deposit there. So he's definitely committed to this. And they saw prices rising, and they knew that I couldn't save as quickly as the market was going up. So that from that perspective, they didn't want me to miss out on getting into the market, because a lot of people trying to save really can't catch up. So I think that's a reason why a lot of people will help their kids out, because they can see prices rising and they know that if they have got good money habits, let's help them get into the market now. And of course, that's just managing that risk, like Chelsea said, based on where you're at in life and what your own overheads are. A lot of people that are, nearing retirement age, if they've got some younger kids looking to get into the market, they may have paid off a large percentage of their home, and they might be in a better financial position than they were 10 or 20 years ago when the kids were growing up. Kids are expensive. So when the kids move out, sometimes that is an incentive going, it's actually cheaper to help them buy a house, because then they'll get out of my house and stop eating all my food. So there are reasons for and against it.
That's a good one. So actually, just on that, Chelsea, can you talk a little bit more to the fact that, there is a way of doing it as more of a loan, but then there's also a way of it being a gift? I think the legal term is non-refundable gift.
That's right. So if you are giving your child cash, then the lender will want a letter from you saying that that gift is a not repayable gift,
Yeah.
as in not a loan. So
Hmm.
if it's a loan, then it has to be included with repayments on your child's borrowing capacity when they're applying for a loan, and that can have a negative impact. So it has to be a gift. What happens in the background after that, if your child decides that they do want to pay you back, then they're more than welcome to.
Mm.
But you can't have the expectation that it's coming back to you.
Yeah, okay. That's a really good point to bring up, I think. I do want to talk a little bit more about the more negative impacts it can have on the parents soon. But first of all, Luke, how has the Bank of Mum and Dad impacted the housing market, particularly for first-time buyers?
It's hard to say whether there's been a huge impact because it's maybe bringing forward some people's purchasing decisions. But keep in mind that there's a huge percentage of people out there that don't have parents that can help them. And there's a lot of parents that either don't own property themselves or they're just not in a financial position to help. So I don't know if
For sure.
the Bank of Mum and Dad has really made a huge impact. It's definitely helped a lot of people to get into the marketplace, probably sooner than they would have anyway. But at the same time, I don't think it's had a massive impact. But those that are in that position, I think, are quite fortunate. If we look around the world, there's a lot of countries where owning a home is just never even an option. It's renting for life, and that's sort of where we're heading in Australia over the next 10 to 20 years or so, where people are just growing up now expecting just to rent forever. So for those that are fortunate enough to be able to help their kids, that's fantastic. But as far as overall impact on the property market, it's probably not made a huge dent in the actual house prices as such.
Okay. So, Chelsea, how can parents then ensure that their financial assistance doesn't negatively impact their own financial well-being in the future?
So if they're giving their child cash, I think setting the expectation that cash is not coming back is the best way of doing that. If they are going guarantor for their child on a home loan instead, so putting their property up as security, ideally putting an investment property up as security rather than your own home is a good idea. And understanding your child's financial habits. So if they're coming to you and they've been full-time at work for the last 8 years and they've saved $2,000 for a deposit in that time, and they're coming to you saying, help me out, potentially chatting to them about improving their saving and spending habits might be a worthwhile chat before you actually go ahead and put your house up as security for their loan. On the other hand, if they're showing good spending habits and they've got good savings, then it's probably a much safer bet. The issue with the guarantor loan is that, so you're literally putting your house up as security as well as the child's house for a loan. So if they stop paying, the bank will sell their property, and if that's not enough to cover the loan, they will sell your property too.
Yeah.
So, and that is a big risk. So there are some lenders who kind of limit your liability. So instead of being responsible for the entire loan, you're only responsible for your 20% plus cost portion. That's a good way of limiting how much you're up for. But also too, while you're guarantor on that loan, making sure that your child is making the repayments on the loan and checking in with them, because the bank won't tell you if they're not.
Yeah, okay.
And then having them, as soon as the equity in the house, the property price has grown enough where they can take you off as guarantor, getting your property taken off.
Yeah, well, okay, so communication between families is really, really key here.
Absolutely.
For sure.
Yeah.
And if this isn't done properly, can this affect things like intergenerational wealth?
I think yes, because if it's not done properly, I mean, it doesn't necessarily have a huge impact on intergenerational wealth if everything's done properly. If your child defaults on their loan and you have to sell your house as a result of that, that's obviously going to have a big impact on your lifestyle, your children's inheritance, and how that's going to work moving forward.
Yeah. Luke?
Yeah, I think the thing with affecting your overall wealth, intergenerational wealth, and I guess your family's financial position, it really does, like Chelsea said, comes back down to how good your money habits are. I mean, every family is going to be different. If somebody's saved up $2,000 versus saving up $20,000 or $30,000, everyone's going to handle that differently as far as how much trust they put in their children's financial, I guess, abilities. But of course, if they've been renting for a long period of time and they've managed to maintain a rental property and they've got some savings, then it really does impact on their commitment to buying a property. If they're the type of people that are sort of buying a house seems like a good idea at the time and they're not sort of committing to stuff long term, that's where things could go wrong. So most people, if they're in a conversation with their kids about borrowing money or going guarantor on a loan, you would hope that there's been other conversations around money habits and what their commitment levels are, and to make sure that you've covered your own risk before going on as a guarantor. And like Chelsea said, as the banks aren't going to actually just take you off as a guarantor. They want as much security for as long as possible. So if you do go guarantor, or if you have gone guarantor for your kids 5 or 6 or 7 or 8 years ago, make sure that you go back and get yourself taken off as a guarantor, because most likely the banks aren't just going to take you off automatically after a period of time going, well, there's enough equity in that property now, we're going to take the parents off and give them a bit of a break. They won't do that. So you would need to go and actually ask to be removed as a guarantor, which will probably mean another valuation gets done on the property, and it will be a formal process rather than just a quick phone call. And that's another way of mitigating that risk as well, and just making sure that it's actually in your calendar after 1 or 2 or 3 or 4 years that you actually make an effort to get yourself removed as a guarantor.
Oh, that's a really great point to make. So who are the experts that from the start of this process to all the way through, who's kind of the first and then maybe the second experts that you need to talk to make sure this is all happening properly and that no one's getting stitched up in the end of it?
Well, I think from my perspective, the experts are probably, you're going to need someone like Chelsea, someone as an expert in finance to work out what the options are, because once you know your options, then you can look at whether that's palatable for the family members involved. Because if there's a cash transfer that has to be made, if there's a property put up as security, or if there's a guarantor position, that's going to be different for every family member. So I think speaking to an experienced mortgage broker that's actually dealt with this many, many times before. And when I say experienced, I mean somebody that's been around for a long time in mortgage broking, not somebody that's just started in mortgage broking, or your local real estate office that's got a mortgage broker sitting there on the weekends. You want a proper skilled mortgage broker that can look at all of these things. And Chelsea's experience really is key for something like this, to give all of the options, because different lenders are going to have different scenarios that can play out. So one might not need the parents to go as guarantor, but they might need a slightly a bit of extra security, for example, but it means the interest rate's going to be lower. One of them might have a higher interest rate, but there's less risk for the parents. So all of these things need to be factored in together. Talk to the mortgage broker, make sure that you've got a really good understanding of all of your options. Some of them might be a little bit more expensive as far as what the lender is offering. But it might mean that it's a better outcome for the parents because there's less risk involved. So having those conversations first, but then having a proper family conversation around what's going on here, who's really at risk, and what happens if something does go wrong. So if, let's say, for example, the kids are working hard and one of them loses their job, do they have income protection insurance? Little things like that they can put in place to make sure that they have ongoing income if they did lose their job, so that they can meet those mortgage repayments if something did go wrong. The other thing that I see as a bit of a risk here as well is if you've got you see often a young couple will get together, and the young couple gets together, they want to buy a house. One of them might have saved up a bit of a deposit, or they might have saved up a bit together. And then the parents of one of the couples goes guarantor or helps out with the deposit on the home, and then that couple goes their separate ways. That can be a very different situation. So if you've got one kid, your son or daughter, for example, wants to go and buy a house, that's fine. Your son or daughter and their partner want to go and buy a property, that brings in a whole nother layer of risk, because relationships don't always last. Surprise, surprise. And there's the old saying that 100% of divorces begin with marriage, right? So from that perspective, you need to make sure that you are looking after yourself. If you're helping out your kid and their partner or their spouse, to make sure that there's proper documentation there. If something did go wrong with that relationship, to make sure that you and your kid are protected in that. And that can be a financial agreement or some other agreement that's put in place that if you do go guarantor, you get the choice of what's going on if you were to help them out. And just make sure that you go into that knowing that as much as they might be together today and everything looks fantastic and they're all good, things can change. So always go in with open eyes, make sure that you're saying, look, even though we don't expect this to happen, statistics show that relationships don't last forever, and that's fine. Let's put that on the table, have that conversation, and accept the fact that if that does happen, this is what's going to happen with the house and with the guarantor and with the deposit and everything else. So all of those things need to be discussed as well, and it's much cleaner and it's better for everybody to have those conversations up front than have to deal with it later down the track when there's no documentation in place and there's the partner's family gets involved and there's all sorts of issues that can happen. And it happens all day, every day because people go into these things blind. Now, that's generally for an owner-occupied situation. Chelsea, you've probably seen many situations where people are using a guarantor or using their family to help them to get into an investment.
I have.
From my perspective, I think that's probably a little bit safer because a good chunk of the mortgage payments are coming from the actual tenant, and so I think that can mitigate some of the risk as well.
Yeah, absolutely.
Yeah, Chelsea, you've seen many sort of different situations and relationships all play out in your time as a mortgage broker?
I have. Buying an investment property with a guarantor, I definitely would say, is a lot safer for that exact reason, that there's rent coming in. So as long as the tenant's paying rent, then most of the mortgage is covered, which is a much safer position for the parents to be in. Mm-hmm. Also, people are more willing to sell an investment property if things go wrong.
Than the one they're living in. Yep, that makes complete sense. Yeah, for sure. So guys, to wrap up, I just want to finish with some sort of final advice that you would give someone who is considering relying on the bank of mum and dad for financial support. I know you've kind of peppered it throughout this episode, but if you're to leave everyone with one bit of advice each, what would you go with? I'll start with you, Chelsea.
I think going into it with your eyes open, having good discussions, family discussions. People don't like to talk about money and they don't like to talk about their financial position.
Yeah. But
right. If you're going to ask your parents to go guarantor, or if you're the parent going guarantor, you need to go into it knowing what your child's financial situation is, and you need to be able to have open and honest discussions about that beforehand and ongoing.
Mm-hmm. Yep, I think that's great. Luke?
Yeah, I think transparency is key. So you need to have open and honest conversations with your family members about your position and what their position is so that everybody's clear. Don't hide anything. It's going to come up eventually anyway. It's going to wreck relationships. It's not worth doing. But I think the biggest bit of advice that I could give anyone going into this situation is that, look, it does work for a lot of people and it can be a win-win. If you both go into it knowing that it's a win-win outcome, then it can be worth doing. But just know your risks before you get involved in lending family money for any reason, getting involved in a guarantor situation or putting up one of your own properties as security. Know what your risks are. And if you need to, if you're not comfortable with how it's all structured or if you're not sure, get legal advice. It doesn't, as much as I hate dealing with lawyers when you don't have to, but, spend some money, go and get some legal advice from somebody that does either family law or contract law that can actually just make sure that there's an agreement between both parties. And it sucks to have to put legal agreements in place with family, but at the same time, the relationship with your family is more important. And I would suggest that if that's the case, put a legal agreement, even if you write it up yourselves. Right, if this happens, this is what happens. And at least you've got some agreement between you so that everybody knows what happens, because people forget and things can change 1 or 2 or 3 years down the track. And the whole conversation was forgotten and all of a sudden you're in a different position. So just make sure that you're protecting yourselves to protect your relationship with your family.
Yeah, it's clear that it plays a significant role in the financial lives of many young people, particularly in this current economic climate. But it's important to remember that parents should have that open and honest discussion with their children about their financial situation and their expectations as well. And then while children should be realistic about what they can and can't afford and kind of why they're asking for this assistance from the bank of mum and dad.
Yeah, absolutely.
Yeah, and that's another good point just to mention in there as well is that sometimes the only reason they're looking for the bank of mum and dad to get involved. It's because they're spending more than they should be.
Yeah.
So often, it's probably putting things into perspective. And yes, I mean, my first property was $157,000. It wasn't in the nicest suburb in Perth. It wasn't in the best part. It wasn't in the best street. It was a house that was good enough for me at the time, and I was proud of it. It was my own home. Did I want to spend 2 or 3 times that? Absolutely. If somebody had lent me the money, I probably would have borrowed it and maxed myself out. But at the same time, it does make sense sometimes just to, Scott, who works with Chelsea, always says, act your wage.
I love that saying so much, yeah.
Spend what you can afford. So sometimes going to the bank of mum and dad might mean that you're actually spending more than you should be anyway. And sometimes you just need to put a lid on it, swallow the pill, I guess, and buy something that's within your price range. Suck it up, like they say, and just live in something that's, for a couple of years, get yourself into the market, and then you can move on after that and upgrade later on.
Yeah. Well, I want to thank you both so much for your time today. It's always so great to learn from you both. I know a lot of people will get a lot out of this, and this will open the eyes of many people to what the Bank of Mum and Dad really involves. So thank you so much, guys.
Pleasure.
Thanks, Phoebe.
If you found this episode or any of our episodes helpful, please make sure to share and leave a rating to help us reach more people on their investing journeys. And of course, subscribe to be notified when new episodes drop. Make sure to follow the podcast on Instagram at Investor Intelligence Podcast. You can find links to our other socials in the show notes, including a link to the Property Mentors weekly blog. If you're ready to get your property portfolio in shape for financial freedom, check out Luke's latest book, Property Fit. You can get yourself a copy at www.propertyfitbook.com.au.